Welcome to FAS 109, Treatment of Foreign Income, by Section 1, Group 7. In this presentation, we will illustrate the book tax consequences of Subpart F income and foreign taxes. These differences occur when a company has foreign income. Let's walk through an example to illustrate these differences. In this example, Uncle Sam Corporation has $1 million of domestic income. Foreign Corporation has $1 million of income. Uncle Sam Corporation owns 100% of the foreign corporation located in the Cayman Islands. Foreign Corporation pays a $10,000 dividend to Uncle Sam Corporation. The U.S. tax rate is 35%. The Cayman Islands tax rate is 0%. Let's first look at Uncle Sam Corporation's treatment of the subsidiary's income for financial purposes. The basic premise for the book income is that everything is included. This is the simple side of FAS 109, or ASC 740 as it is now called, in the foreign income area. The first journal entry is to record the income received from the operations of the foreign subsidiary. We record this with a debit to investment in foreign corporation and a credit to investment income. The dividend received from the foreign corporation is recorded on the books with a debit to the cash account and a credit to investment in foreign corporation. Before moving into the tax areas, we wanted to give a few basic definitions that will help clarify things later. A foreign subsidiary is considered to be a CFC, or Controlled Foreign Corporation, if 50% or more of the total voting power or value of stock is owned by U.S. shareholders. For tax purposes, a U.S. shareholder is a U.S. person who owns 10% or more of the stock of the foreign corporation. In our example, foreign corporation is a CFC because it is 100% owned by Uncle Sam Corporation, a U.S. shareholder. Sometimes, U.S. companies will push income to a foreign subsidiary located in a low-tax jurisdiction when customers are located in a third and separate jurisdiction. In our example, the foreign sub is located in the Cayman Islands, but the customer base may be in Japan or Australia. Placing the subsidiary in the Cayman Islands is done strictly to avoid income taxes and does not serve a business purpose. The U.S. government has implemented Subpart F income to try to eliminate income tax avoidance, among other reasons. Subpart F income is the sum of insurance income, foreign base income, boycott income, and income from bribes. For this example, foreign corporation's Subpart F income is $300,000. Income is generally not taxed from a foreign subsidiary until it is distributed to the U.S. parent. However, if foreign subs have Subpart F income, that is taxed as a deemed distribution the year the income is received. In our current example, the deemed distribution is taxed, but until the actual distributions to the U.S. parent exceed $300,000, the amount of our Subpart F income, Uncle Sam Corporation will not pay tax on the dividend. Now we are ready to look at the income tax expense. As a reminder, foreign income is normally not subject to U.S. taxes until it is distributed up, but because there is Subpart F income, that portion will be subject to U.S. taxes as a deemed distribution. We first reconcile the book to tax income. The book income is $2 million. That amount is decreased by the amount of foreign income that is not taxable this year, or in other words, the $700,000 difference between total foreign income and the Subpart F income. That gives us our taxable income of $1.3 million. Now multiply that by the U.S. tax rate of 35% to arrive at our current tax expense of $455,000. To calculate the deferred tax liability, we multiply the $700,000 temporary difference created by the subpart F income by the U.S. tax rate. We then arrive at a $245,000 deferred tax liability. Here are the journal entries to record both the current and deferred tax expense on the books of Uncle Sam Corporation. To record the current tax expense, we debit the expense and credit taxes payable for the current amount of taxes owed. To record the deferred tax liability created by the favorable subpart F income, we debit deferred tax expense and credit the deferred tax liability. Here is how a basic income statement would look for Uncle Sam Corporation. The income from Uncle Sam Corporation is combined with the income from the foreign corporation, and then the current and deferred tax expenses are taken out to end up with the net income of $1.3 million. Now we will discuss some of the book tax differences of foreign taxes and foreign tax credits with a slight modification on the first example. In this modification, assume the Cayman Islands has a 10% tax rate and owes $100,000 in taxes. Our foreign subsidiary will still have $300,000 of subpart F income. If you remember the basic principle for financial accounting purposes in dealing with foreign income, you know that generally everything is included on the financial statements. Foreign taxes paid are a deduction on the books. Therefore, the income Uncle Sam records on its books from the foreign corporation, from its foreign sub, is $100,000 less than the first example. Otherwise, this journal entry is the same as before. The dividend entry does not change. Foreign taxes are credited for tax purposes. They are not taken as a deduction like they are for book purposes. This creates a permanent book-to-tax difference because the credit offsets taxable income that will never be paid, hence a difference. There is a limit for the credit, however, but that is beyond the scope of our discussion today. Here, we are revisiting the income statement, and you will notice that the current tax expense changes because of the foreign tax credit, thus lowering our income tax by $100,000 from the first example, giving us $355,000 of current tax expense. As a quick review, we hope you can take away at least 4 things from this presentation. First, for financial purposes, all foreign income is included on the books. Second, for tax purposes, foreign income is not taxed until there is an actual distribution to the U.S. corporation. Third, subpart F income accelerates the taxation of foreign income, but because not all income is taxed up front, there is a temporary book-to-tax difference. Fourth, and finally, foreign taxes create a permanent difference. We appreciate you watching the presentation today. Here are a few of the resources that we use.